This is Charles Jam empowering you with financial ideas. So let's talk about SVB Bank, Silicon Valley Bank. Why did it fail? Why do banks fail in general? And should you care about it? So let's start first with looking at SVB Bank. They started growing enormously through COVID from 2019 onward. Their stock value went up. The amount of their deposits doubled, tripled annually. It was during the tech boom during COVID. All these tech stocks were doing so well because we were working from home, and that's where the money was flowing. And they swelled up really nicely. Now, as we came out of COVID from the tail end of 2021, guess what? Those values started coming down. And all these tech companies that made big deposits at SVB started pulling their money out. Remember, their deposits are only insured up to $250,000, which was very small compared to a lot of these companies that were making deposits in the tech area, raising money and putting them with SVB Bank. They started pulling these deposits out, and after the cash was exhausted at SVB, they still were requesting that their deposits come out. So as time went on, SVB had to start selling their long-term securities. Now let's talk about that. When a depositor puts money at the bank, let's say back several years ago, or even a couple years ago, you only got 1% for your money at the bank. You remember you refinanced your mortgage for 2.5%, 3%, some at 2.25. Very low interest rates we may not see again in a long time. So they give you 1%. They buy a long-term, let's say a 10-year bond, for instance, that pays 3%. That's how the bank makes their money. They pay you 1, they make 3. Everybody's happy, sort of. But then what happened? Inflation rose, so the Fed started taking up interest rates to control inflation. So now let's say the bank had a long-term investment of 3%. They have to sell it to give these depositors their money back when they say, hey, we want to pull our money out of your bank. They sell this long-term investment. Let's say it makes 3%, $100,000 bond, 10-year bond. But now you can buy a $100,000 bond maybe for 5% or even 6%. Who wants that 3% bond? Nobody, unless they buy that $100,000 bond at a discount to par value. And so maybe they offer them $80,000 for a $100,000 bond. They have to take these losses and sell these long-term investments. In fact, well over $1 billion that SVB Bank lost to create this liquidity so they could pay their depositors back their money if they wanted to withdraw their money. So what did SVB say? Well, how are we going to pay these other depositors that come into us? I know what we'll do. We'll issue common and preferred stock. We want to raise over $2 billion. Well, they made that public announcement. They're looking to raise over $2 billion in stock to increase liquidity. What? Their depositors said? And they ran on the bank and demanded their deposits back. Guess what? The bank failed because they couldn't produce all that money. The FDIC said, we're guaranteeing up to $250. Federal government came in and said, we're going to guarantee anything above the $250. Will they continue to do that? Who knows? Will that be an issue? Who knows? But that's how that bank failed. What I see in any crisis is opportunity, at least 3 major opportunities that may exist right now in the time period we're in. This is Charles Jama, empowering you with financial ideas.